Hey everybody, welcome back. Hey, what we've been doing is we've been talking about demand. We had a few videos on demand and a few videos on supply to really get you the groundwork for demand and supply. But now we're finally ready to bring those two things together, okay? And then we get the market, okay? We're really finding market equilibrium. Now, when anybody says anything about the market, what are they talking about? They're saying the actions of the market participants. And who are the market participants? Suppliers and demanders. So you hear somebody say, hey, the market is giving us this price, or the market says that that price won't work, or that price is too high, or that price is too low. What they're saying is the market participants, the interactions of the suppliers and the demanders is so that that price is not the right price, okay? So we're going to walk through how to find the market equilibrium. Now some of you might be thinking, hey, you know what, market equilibrium, that couldn't be any easier, right? You're just like, supply curve, I know that's upward sloping. Demand curve, I know that's downward sloping. Just go find the intersection point. That's what I'm told. Just find that intersection point. Hey, that's quantity equilibrium. That's price equilibrium. And that point right there is the equilibrium point. And you're right. That actually is absolutely all there is to it. But what we want you to understand here at Econ Busters is how we find that market equilibrium. And it's the market that finds that equilibrium. We want you to understand the process, okay? That's what this video is all about. So I'm going to erase that. And what we first need to know is these supply and demand curves, for the most part, aren't written up there in the sky. We can't see them. Even firms themselves don't really have great pictures of the supply and demand curve for most industries, okay? They exist, okay? And there is an upward sloping supply and a downward sloping demand, but we can't just go look over there. Oh, there it is. That's the intersection point. That's the right price. The market finds the price. And what they really find is the market clearing price. So let's go through this, all right? The market actually says one of two things or says nothing at all based on any price the seller sets. Okay, that's a lot. Let me say that again. The market determines the price, okay? But who sets the price? Who puts the price on price tags? That's the seller, okay? Keep that in mind. We're gonna say all the time the market determines the price, but who's the ones that's responsible for putting the price on the price tag? It's the seller, of course, right? So the seller puts a price on their goods, and then the market is going to say one of two things or nothing at all. One thing the market might say is surplus, okay? Inventories start going up. Or the market might say shortage, and that's when inventories start going down or lines start to form. Or the market says nothing at all, and at that point the market is clearing and you found the equilibrium. So let's go through it. Let's just imagine, we don't know what these curves actually are. We just know they exist, so we're just going to put a price on our goods. And so we put the following price, P sub 0. What's going to happen at that price? Hopefully you can just look at that and go, hey, that's too high. Absolutely it's too high. And so what's going to happen if the seller puts that price on the good? Well, this horizontal distance right there is going to be the quantity demanded. Let me say that again, very important. You'll see us doing this in future videos quite a bit. That horizontal distance at that price, notice I'm intersecting right there with the demand curve, is the quantity demanded at that particular price. Now, this horizontal distance at that price is quantity supplied. So I've got quantity demanded, quantity supplied. What's the market going to say? Surplus. Now, I start seeing my inventories go up. This is a surplus. What am I going to do as a seller? I'm going to do the natural thing any of us would do. As we see our inventory levels go up, we'd lower the price. So let's say we lower the price to P sub 1. Well, I know we can already see, hey, that's too high a price, but let's just make sure we understand why. At that price, quantity demanded, that horizontal distance is the quantity demanded at that P1. This horizontal distance is the quantity supplied at that P1. The market says surplus again. So the sellers say, oh wow, I've got to lower my price even more. But they might miss it. They might not go there. They might go too far, okay? So let's put a P2 down here. We drop it a lot this time. And I go across at that price right there. This horizontal distance, notice I'm hitting the supply curve now. That's the quantity supplied. This horizontal distance is the quantity demanded. What happens if the quantity demanded is more than quantity supplied? Shortage. Either I see those inventory levels dropping really fast, or maybe I even see that line starting to form outside my business. That's conceptually a good way to think about it. So what does shortages tell us to do? That price is too low. Let's raise the price. So we, raise the price. Now actually, let me pause for a second here, okay? What was the last two prices? Or let's go through this really quickly. First we put P sub 0, that told us lower the price. Then we put P sub 1, that told us lower the price. So we know the price has to be lower than P sub 1. Then we put P sub 2, that said raise the price. Hopefully you're kind of understanding that price is going to stay in that range and it's just going to close in, close in. I could do one more, I don't know, let's just very quickly do a P3, draw it across, make sure we've got this horizontal distance quantity supplied. I'm hitting the supply curve. I'm saying that's the quantity supplied at P sub 3, quantity demanded at P sub 3. What are we going to get? Shortage, raise the price. So let's go to our final price. That price equilibrium, sometimes called price market, or what you'll oftentimes hear me refer to it as is the market clearing price. What do we mean by the market clearing price, where the market clears? We mean at this price, this horizontal distance is not just the quantity supplied, it's also the quantity demanded. So we go down here and we say Q equilibrium, and what is Q equilibrium? It's quantity supplied equaled quantity demanded. That is indeed our equilibrium, but that's the process by which the market finds the price and the output, okay? The market, the interaction of supply and demand, finds that price. Hopefully that made sense to you, and that's going to help you out in future videos. Thanks for tuning in. We'll see you in the next video.